Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. To everything, turn. Things turn. NASDAQ is moving toward a correction while the S&P equal weight is hitting all-time highs. Home price appreciation in real terms has turned negative. And for the first time in decades, equity supply is positive. And then there's the Fed. The Fed is done with hand-holding and guiding. As one asset manager summed up this week, the focus is back on understanding underlying trends in the economy, what's happening to inflation, what's happening to growth. The market has to figure things out. Imagine that. This week, our three things are: 1. Q2 GDP. It's better than the headline, but... And 2. Consumer resilience. Visa and Capital One provide views across the consumer landscape. And 3. Recalculating inflation. Improvements are on the way. All right, let's dig a bit deeper. Q2 GDP. So Q2 real GDP growth is out, and the headline number, 1.5%, came in weaker than expected, but interestingly came out on top of the Atlanta Fed's GDP Now estimate, for what that's worth. The result was well below the 2% consensus estimate, the prior quarter's 2.1%, and the Fed's 2% longer run estimate. But let's peel that onion a bit. The so-called core real GDP, that's final sales to private domestic purchasers, jumped to 3.9%. That's up from 1.7% in Q1 and the strongest level since Q1 2023. The core GDP number is what drives the underlying economy, and that's consumer spending and business investment. The headline calculation excludes net exports, inventories, and government spending. Consumer spending rebounded to 3.2% quarter-on-quarter, well above the estimate of 2.3% and the longer-term average of 2.4%, and a healthy recovery from Q1's anemic 0.5%. As we know from color that comes from consumer lenders, Q2 spending benefited from a number of things, including extraordinarily high tax refunds. That helped to offset higher gas prices, by the way. You had strong World Cup spending, strong wealth effect courtesy of the historic stock market gain, and a still low rate of unemployment. Over on the business investment side, the sector is benefiting from that fourth industrial revolution, yes, AI, and historically high margins. Business investment grew by 3% in the quarter. That's down from the 7.9% in the previous quarter and the longer-term average of 3.5%, but relatively healthy nonetheless. So, a better-than-the-headline report, except for the personal income and spending report for June. Both came in considerably weaker than the estimates. Disposable personal income grew just 0.2% quarter-on-quarter versus an expectation of 0.7%. Personal consumption expenditures grew by just 0.3% versus an expectation of 0.9%. Moreover, the savings rate continued to plummet. It's now down to a meager 2.7%, less than half of its long-term average of 6.1%. Net-net, the consumer continues to spend, and it has the wherewithal to spend. But this week's reports suggest a slowdown, a modest one, but a slowdown nonetheless in spending in the second half is looking like a reality. All right, on to our second thing, consumer bellwethers. So a couple of weeks ago, we got an updated look at credit from the large banks, and all was well in both consumer and commercial books. This week, we look at two more broadly based consumer bellwethers, Visa and Capital One. Let's start with Visa, the self-proclaimed leading hyperscaler of payments globally. The company reported a modest beat on strong 10% year-on-year growth in both payments volume and processed transactions. In the U.S., there were a number of unusual tailwinds, including those higher tax refunds we mentioned earlier, the rising cost of fuel, and World Cup-related spend. Now, two of those, tax refunds and World Cup spend, will not be repeated, and the third, the rising cost of fuel, obviously can cut both ways over time. Yes, payment volume increases with the jump in fuel prices. Over time, that burden presumably comes out of other spend, especially for lower-income households. In any event, higher fuel prices net-net are likely a positive in terms of spending volume. The company opined that the consumer spend environment remains strong and resilient and pretty broad-based. We're seeing improvements around credit and debit, discretionary spend, non-discretionary spend, card present, card not present, and across the spend bands as well, according to management. The company lifted slightly its full-year outlook for net revenue growth to the low end of low teens, up from an earlier forecast of low double-digit to low teens. Over at Capital One, management observed that credit continues to come in very strongly. The quarter featured a reduction in the size of the loan loss reserve relative to the total domestic card portfolio, driven by what management called continued favorable observed credit in the quarter and a modest decrease in the consideration given to economic uncertainties. Management added, "When you pick up the news every day, one would think the world's falling apart, but actually the consumer continues to perform remarkably well. When we look at bank balances and debt servicing burdens of our customers, these look a bit stronger than a year ago across income levels. We continue to see healthy spend growth driven by both account growth and by steady growth and spend per customer." Management notes that credit performance is very consistent across the credit spectrum. "We don't in our own numbers see this K-shaped economy that a lot of people talk about." It is worth noting, however, that management has been trimming on the margins recently acquired Discover's credit policy in areas where Capital One management is less comfortable with the resiliency of the underlying customers. That, of course, implies that not all is well on the consumer front, but in the aggregate, bad debt costs among the large, advantageously scaled consumer lenders remain quite favorable. All right, on to our third thing, recalculating inflation. So no shortage of attention on inflation this week given the FOMC meeting. Not that we got much on that front from the committee, as its statement barely changed. Inflation remains elevated relative to the committee's 2% goal. That's a repeat of the language in the prior meeting statement. No surprise there in light of Fed Chair Kevin Warsh's commitment to less is more in terms of Fed communication. But what is interesting is changes are on the way as to how inflation is calculated. The Bureau of Economic Analysis, the federal agency responsible for calculating the Fed's preferred inflation measure, that's personal consumption expenditures, is improving its word, the way it calculates three components in the PCE index that account for some of the discrepancy between PCE and the Consumer Price Index. Those components are prices for legal services, portfolio management services, and computer software and accessories. Press reports say the changes will lower PCE inflation by about 0.2%. The changes are due to take place in the August data that will be published September 30th. And then there are possible changes on the way to how the FOMC views inflation, courtesy of one of Chair Warsh's task forces established to do just that. In the past, he has suggested considering alternative views of inflation, specifically citing a variety of measures, including trimmed mean metrics, for example. He also is an advocate for incorporating more real-time data into the inflation analysis. A possible target there would be the shelter component, where owner's equivalent rent features a long lag and a survey-based methodology, as opposed to monthly measures of actual transactions on home sales and rentals. That alone would bring reported inflation today meaningfully lower. We have long worried about the quality of data coming from dated methods of gathering that data. The Fed's updating will help build credibility. So there you have it. Three things in credit. 1. Q2 GDP. Consumer spending has rebounded convincingly, but will it last? 2. Consumer resilience. Visa and Capital One confirm, at least for today, the consumer's durability. And 3. Recalculating inflation. Improvements are on the way. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.